All right, well, we will go ahead and get started. Good afternoon, everybody. My name is Alex Oliver. I'm a financial planner with First National Corporation, and you're tuning into our financial boot camp series, which we do with Schwartz and Schwartz accountants every year. We're going to go through a little bit of the economic situation over the past few months, give you an outlook for 2019, a lot of volatility in the last month or two, and a lot of interesting headlines, which we'll try to weed through and see what's relevant and what's not. So just by way of quick introduction, again, I'm with First National Corporation. We are what's called a registered investment advisor. We work with mostly families with a little over 400 households that we manage, but also we have a dedicated retirement practice where we serve as the fiduciary on 401k plans. Our base job is to choose investments and investment allocation for our clients, but these financial plans end up having a lot of income tax consequences. We end up reviewing estate plans and insurance policies and things of that nature. So we're really the quarterback to these whole financial plans. And obviously having a look on the overall economy helps to dictate what our investment allocations are going to end up being for the year. So this should help to just at least give you a little bit of thought insight on what our thought process is. For a little bit more insight, we have, again, a series of webinars that we do every year in tax season. Right now, again, today, February 7th, we're doing the economic and investment overview. If you missed the one earlier, we did a Social Security webinar, all sorts of different topics around claiming strategies and other considerations. In a couple of weeks, we'll be talking about the stock market specifically and why stocks are going up and down based on either the valuations or the news and whatnot. So hopefully to clarify a little bit of the mystery behind the stock market there. And then finally, in late March, we'll be doing a generational wealth transfer for some of our retired clients who are thinking about passing on money to either charities or heirs. If you want to go and see the pre-recorded webinars or sign up for the future webinars, schwartzaccountants.com/events/bootcamp. This is a quick little list of what we have done. This also includes some of our webinars from last year. So topics such as saving for college education, dealing with student loans for some of our younger clients that are coming out of medical school with heavy debt burdens, just some thought process there. People that are planning retirement in those last 3 to 5 years, we've got a whole webinar for you and many more. So be sure to check that out and watch a few of those if they're relevant to you. Okay, well, just to get us started here with a little bit of disclosure, as I always say in my webinars, make sure that you don't take anything I say today as advice or predictions as what I think are going to be happening with the market. I'm sure you know by now that it's very difficult to predict what's going to happen in the stock markets. So just, I'd say, take today as maybe more of a cocktail hour chat, something you might be able to talk to your friends about more so than actually making investment allocations off of today's information. So make sure you contact your personal financial advisor before making any decisions. Okay, so let's just kind of recap where we are at. We are taping this again on February 7th, 2019. And so in December, we all know that we had a nice sharp drop in the S&P 500. And this is essentially showing us a nice snapshot of just about the last 20 years, where again, we had our tech boom and then we had a drop here, our Great Recession with the housing market getting down to the lows in 2009. But essentially, on the long term, it's been a upward trend for the last 10 years. We've had some dips. We had a bit of a down year in late 2015 and early 2016. Then we ran up again. And again, in the beginning of 2018, actually had a nice little run up. And then towards the end, and again, especially December, we had a very sharp drop. Now, again, what's not pictured here is the month of January 2019, where we've had a nice little bit of a recovery. So a little bit more volatility than usual. And I want to just discuss maybe why that's happening and what we should be thinking about moving forward. There were essentially 4 things that were in the news in December that are still relevant today. One was rising interest rates. The Federal Reserve is raising interest rates, which typically hurts investment returns as people have to pay more money to borrow and they can't necessarily expand their business. So rising interest rates is one. The government shutdown happened in late December and carried into January. There was a lot of concern around that and how that would affect the economy. We had ongoing trade wars with China. Not a lot of progress there between President Trump and Xi Jinping to get a deal in place. So concerns about how that would affect the overall economy. And then finally, in December of 2017, we had a tax bill that, most importantly for our discussions today, really cut the corporate tax top rate. And that gave corporations a lot of new money to be able to invest in 2018. And now those effects are essentially wearing off. So there's a lot of concern going into 2019 as to whether that shot in the arm is really going to carry us to better returns. So again, I want to continue talking about all those things as we start to look at some of these charts and get an idea as to where we stand. So, again, just to put it in perspective, this is a long-term chart that shows what the intra-year declines were in any given year. So, for example, back in 2008, when we had our big economic crash, it was down as much as 49%. But then the gray marks here show where the S&P 500 actually finished during that year. So again, in 2008, we were down as much as 49%, but we finished down 38%. Other years where we had some really big lows here over the last 10 years or so, that actually finished up. I think I want to point you to this little line right here that says, despite an average year where we dropped just about 14%, we've actually had positive returns in 29 of the last 39 years. So now we go ahead and look at 2018, where our intra-year decline was actually 20% once we got to the low there in December, and then we recovered to get to only down 6%. But again, that's a negative year there. So very uncommon to finish the year on a negative perspective. Maybe something that you could look at moving as positive looking forward. Also, you can see again, 20% down is higher than our average intra-year decline. So that volatility, I'm sure it hurt watching it in the news, and you can feel justified that, again, it was above average volatility there. So, one thing I like to look at and help to, again, keep things in perspective for anybody that's been investing for a long time, you remember when the Dow Jones hit certain markers and those numbers continue to get larger and larger. Same thing with the S&P 500. I like to look at things not at a price perspective, but more of a valuation perspective. Because if earnings are rising amongst United States companies, so should the price of the stocks that we end up buying. So this chart is showing price to earnings ratios. And I think the ratio is an important key to look at, because back in 2000, 2001, when prices for tech companies were really high, but they weren't earning a lot of money, that was a pretty good indicator that we were going to have some sort of downturn in the near future. Whereas in other years, when prices are really low compared to what companies are earning, it may be an indicator that things are going to look good looking forward. Kind of corresponding with December's mood, you could look at the drop in the S&P 500 as maybe a Black Friday sale or a Cyber Monday sale. We don't typically think about it like that, where we want to go and buy stocks at a cheap price, but that might be how I might encourage you to look at it. This is just showing that, over the last 25 years, the average price to earnings ratio is 16.1. Okay, so the price of the S&P 500 divided by the earnings gives us a ratio of 16.1 on average. With our drop in December, we got down to 14.4 price to earnings ratio. So that is lower than average. Prices are lower than average compared to earnings. Now, over the next 1 year, you can see a little scatter plot of what the returns were 1 year after the valuations hit certain points. And they're kind of all over the map, frankly. I wouldn't say that the correlation here is strong enough to really look at. But for long-term investors, this is just looking at a 5-year annualized return. The correlation is actually a little bit stronger. So for a valuation at 14.4, excuse me, again, cheaper than normal, also higher than average returns for the next 5 years. So I think, again, any long-term investor should sort of look at a dip like that and say, great, I get to buy stocks at a cheaper price. And therefore, since I'm retiring 10 or 15 years from now, in the end, I'll end up better off for it. Looking at valuations another way, we should also know that stocks are not just the S&P 500. There are large stocks, there are small stocks, international stocks versus American. There are what are called growth stocks, which might be your Apple or your Google. There are value stocks like your Coca-Cola or your General Electric. Across the board in 2018, we ended up down in every category. These market returns are a little bit correlated in that sense. But if you want to look for certain areas of the economy that you might focus in, this chart might actually help you to pinpoint that, at least again on a valuation perspective. So for example, large growth companies lost the least in this category in 2018, only down 1.5%, versus large value companies that were down 8.3%. So again, what do we take from that? I'd say not a whole lot, but let's go over to the current price to earnings ratios versus their 20-year average. And we would see that both are cheaper than their 20-year average, but again, growth is just a little bit cheaper than value. On top of that, maybe we can go down to the small company space, and we would see that actually small value companies are really cheap as compared to small growth companies, which are actually right in line with their historical average. So if you were trying to pick a sector, again, maybe that would be an indicator that would tell you, okay, small value companies, if I've got 10 or 15 years with a time horizon and I can accept volatility, that might be a category to look at based on the correlations that we saw earlier there. Okay, so let's talk a little bit about, a little bit broader economy, what's happening here. I mentioned earlier that we had a tax cut in December 2017 for corporations, and that played a huge role in adding earnings to the bottom lines of corporations. So in 2018, you can see these are the first, second, third quarters. I can tell you that earnings were up 24% in total for 2018, which is a pretty significant amount. You can see over the past years that we typically don't have that much of an increase, except for back in 2010 when we were just coming off the recession and we were coming from very low lows. It's a little bit easier to increase your earnings from there. But typically they're sort of in this range, 11, 5, 6, and then again in 2018 earnings were way up. So that's why even though the stock market continued to go up, the earnings actually justified those companies' stocks rising. This also starts to break down where those profits came from. So a little bit of increased revenue, a lot more margin here, which is it's an important thing to look at, and a little bit from share buybacks. So some of these companies will buy their shares back to make it a little bit of a higher price for their company. And so again, you can look at the averages here, much higher than the average. Now, one thing that you're probably going to see in 2019 is that we are not going to have 24% growth rate in earnings. The consensus forecast right now is that that's going to be about 9%. So earnings of the S&P 500 will grow 9% instead of 24%. So that is a pretty steep drop. It's still growth, but it's still a drop. And so for somebody who's trying to make a bear case on the market, they might say that, quote unquote, earnings are slowing down. But you want to just, again, remember that it's still growing. It is just slowing down from what happened in 2018, which is quite a different year than usual. We're going to talk a little bit about, again, growth in the overall economy, because this is just important to keep in perspective as GDP continues to grow. You can see that year over year, we had a growth rate of about 3%, which is higher than our expansion average of 2.3%. So again, over the last 10 years, the economy has grown at about 2.3% per year. Now we're growing faster than usual. That's notable because in past years, if you look again, going back to the 70s, typically GDP has grown when it grew at a higher and faster rate. So this expansion has been sort of unique because it has been very long, which gets people a little bit worried about when is the next recession going to happen, but it's also been very slow, slow growth at 2.3%. So we're finally getting to see a growth rate that's above average and hopefully sustainable. A big part of that, as you can see, what makes up GDP as a whole is consumption. That's me and you buying goods and services in the American economy. And so if we're looking at GDP growth and how is that going to affect stocks as a whole, we want to make sure we always remember that it's not necessarily government pumping money into the economy and essentially allowing fake growth. We're having consumption from the American consumers, and we'll have to see is the American consumer in a healthy place to help with that growth rate. We'll get to that in a second. So, you've probably seen the headlines about the jobs reports. We in December added 312,000 jobs to the economy. In January, that was 304,000 jobs to the economy. this is pretty significant for an economy that, again, has been expanding for a long time. For it still to be adding jobs and for the employment rate to still be going down is quite remarkable. Frankly, if you're in a job that you don't like right now, this is one of the better times in American history to think about changing jobs because there are more job openings out there than there are people who are unemployed and looking for jobs. So that has helped. That has helped for wage growth, for example. Wage growth has been pretty slow during this economic recovery. And again, finally, you can see this line right here. It grew to 3.3% year over year in December of 2018. So we're all starting to get a little bit more money in our pocket to be able to spend. Again, there are a lot of job openings out there. So even those that are still on the sidelines can get back into the workforce. The labor participation rate is also rising. So people that even were 65 or 66 years old and they retired, there are just a lot of jobs out there, so they've decided to go back to work. And so that's a really good indicator for our overall economy. What may raise some concerns, again, going back to interest rates. The Federal Reserve basically dictates every couple of months what they're going to do with their interest rates. The interest rate is what banks can lend to each other. That's what's dictated by them. And then that ends up affecting our mortgage rates or our savings rates at our bank, for example. And so when the economy crashed back in 2008, interest rates went to zero, essentially 0%, and it stayed that way for a really long time. And we've been slowly raising interest rates over the last 4 years or so. And when interest rates rise, typically if mortgages become more expensive, people aren't so willing to go out and buy houses that are, a little bit more expensive than they otherwise would have. Businesses, again, are not willing to borrow money to expand their business. So we look at this interest rate and we try to figure out, is this going to be a rate that affects the overall economy? What's notable, though, is how high these interest rates typically have gotten in the past. Again, this is 2000, upwards of 6 or 7%. Back in 2006, upwards of 5%. And yet, despite these little tiny raises throughout the years, we're still right around 2.5%. And in 2019, this is actually saying that it's forecasting about 3 new interest hikes in 2019. The Federal Reserve has actually come out and said that they're probably only going to be doing 2 interest rates hikes in 2019. So even though it is going up, it's still a far cry from where we were at 5%. It's not going to get there. The long rate run that they're probably targeting is about 2.75%. So that's encouraging for investors, and I think that has helped in January for the stock market to recover and have a little bit more confidence that, again, rates can be relatively low enough for people to borrow and go out and spend. Okay, so again, getting back to that concept of more money in our pocket, adding to consumption, can the American consumer help with GDP growth to help companies and buy their goods and services and continue to help the economy to grow? This chart actually is particularly interesting to me because this is really reflective of what has happened and how less dependent the American economy is on oil prices, in most part due to the rise in U.S. production of oil. So you can see over the years, the increase in production, millions of barrels per day, and the United States has rapidly risen in this category. So growth since 2015, the United States production of oil has risen 29.5% versus OPEC, which is, a lot of these countries out in the Middle East, for example, that kind of get together as a conglomerate and they decide how much they're going to produce. They've gone down 0.2% in this period of time. What they're trying to do is keep inventories a little bit lower so that way the price of oil is higher when they sell it. And that's been a real struggle for them. Same thing with Russia. Russia essentially is not part of OPEC, so they're on their own there. And when the price of oil has dropped, Russia's been like, well, we need to produce more barrels of oil so we can have our economy still running right, because a little over 50% of Russia's economy relies strictly off oil production. So the rise of oil production in the United States, you've seen this in North Dakota. You've seen this with new technology where we can drill both horizontally and vertically using our reserves that we've already had. That has helped prices to stabilize and keep relatively low. So inventories are higher. They're getting higher than they have been, whereas consumption is still growing at a similar pace. Again, just puts the United States in a really nice place there, puts American consumers in a good place to ensure that the gas pump is not rising rapidly and dissuading them from spending money in other areas of the economy. So, while United States oil may have a hard time with some of that if the oil prices are low, other areas of the economy should do well, again, with the American consumer in a healthy place. Okay. But, again, I'm trying to give you both the good and the bad here, because the other thing to keep on our minds is that when we had that tax bill in 2017, as an example, we really lost a lot of new revenue, and our expenses going out of the federal budget continue to rise. So with baby boomers continuously retiring, healthcare costs going up, both Social Security and Medicare are rising in costs, where our revenues are going down. And so this just shows, our federal budget surplus and deficit. Again, back in the Clinton years, we actually ran a surplus there. Post 9/11, we started running deficits. And then post Great Recession, we really had some deficits that tapered off into 2016 or 2017. And then under the Trump administration, those deficits have started to rise again. This is the CBO forecast of where we're going to be. That aspect of it is not so concerning. I think the world economy has sort of come to the understanding that having debt in itself is not a bad thing, especially if it's spurring growth in your home economy. But that's where this chart is something that I watch every quarter to see where we're at, because the debt as a percentage of GDP is really, what's going to tell us where this debt burden is going to go, and if it's going to end up having a negative effect on the economy. And unfortunately, this is the really concerning part, because GDP has, as I said earlier, not been growing at a fast rate. The economy has been growing very slowly, while the overall debt has been growing very rapidly. So I think even a quarter ago, this number was debt as a percentage of GDP, somewhere around 74 or 75%, and now we're right at around 78%. So the last time that we were at these kinds of numbers was back in World War II. We were funding a war, and I think that could actually be justified. But right now, and again with the CBO forecast, it seems like we're going to get back to those levels again. What does that mean? Short term, it doesn't mean a whole lot, but long term, how do we pay back debt? Well, we either have to cut a lot of spending, or we have to raise taxes on American consumers, which again leaves them with less money and lowers, our overall consumption of American companies' goods. So I watch this one pretty feverishly to get an idea again as we head into the 2020s. What is our overall economic outlook going to look like? And I think I would encourage others to also take a look at that chart and consider that as well. Okay. Just a couple of other charts to bring to your attention. This is the Global Purchasing Managers Index. This is essentially showing around the world what purchasing managers are doing. It's a nice indicator of economic health in the service and manufacturing sectors. So, if these numbers are green, it means that the numbers are over 50. It means that these countries are trending toward expansion. They're purchasing more goods and getting ready to produce more goods. Whereas when we're in red, it means that these countries are actually decelerating. We actually have an economic contraction. So again, post 2008 going into 2009, that's why we have all that red there, because countries were really cutting back. You can see some of the Eurozone in 2011 and 2012 when we had that Greek debt crisis. A lot of red in here as well as they really fought off their debt. And if we fast forward to 2017 and even 2018, a lot of green here. So a lot of economic growth throughout the world, which was a great sign. But now that we're in the midst of a trade war, and particularly with China, we're starting to see China actually dipped below the number 50. So they're down at 49.7 here in December of 2018. Taiwan, they actually label separately here, but is down at 47.7. Korea is also down. So we're starting to see some yellows and reds. Even over here, Italy's got a bit of a debt crisis that they've got to deal with. So they've dipped below 50. And that's a little bit concerning for those kinds of areas. So as you're looking at your overall investments, if you should have both United States and international stocks, you might just want to be a little bit more picky with some of your international investments because growth there is slowing down. And even in the United States, we can see, in November we were at 52, now we're at 51.5. Still accelerating, but maybe a slower pace. And so, a couple of last notes I just want to leave you on here is just in discussion with the overall trade war. I think the overall, administration's policy was to put tax reform in first back in December of 2017, and then, allow American companies to have enough profits to withstand a global slowdown because, it's pretty obvious at this point the Trump administration drew up new trade deals with Canada and Mexico and even the European countries, and now is really focusing on China. Again, we haven't really seen much of an effect of this trade war here in the United States, but that is in large part because, the export as a share of GDP is only 8% of the United States economy. This is actually a 2017 number, so not completely up to date. But the point here is that the United States is really not relying on exporting goods out to other countries, whereas China, 19% of their economy is based on exports. So the takeaway from this chart, again, you can see Korea, Mexico, South Africa, Taiwan. Taiwan was a number that we just saw on this last chart, is really slowing down here, down at 47.7. Well, again, it's because a lot of their economy is based on exporting. And if they're in a trade war, that's going to really hurt them. So we are in a position here in the United States where we can actually drag this trade war on a lot longer than other countries can. And so it'll be interesting to see what happens with a final trade deal here in 2019, whether China or Taiwan or whatnot comes to the table and really makes a deal here because their economies are starting to really see some effects of that. And you would think that they would start to look to come to a deal, but time will tell. So, with that, hopefully, again, I've given you some pros and cons here. I'm overall fairly optimistic, especially with the United States markets and valuations. I think, again, we saw that rise here in January, so I don't have those updated numbers, but, it's something that we look at every quarter and try to get a perspective on the rest of the world to see, if there's anything that we should be watching out for. But, for a long-term investor, I think there's enough to see here where we should be long-term overall pretty optimistic as we get maybe into the 2020s, 2025s. Again, there's some red flags there that we will certainly be watching out for with our investments. So just as a way of conclusion, our website, fncadvisor.com, will give you a lot more information on our business. Again, there's really three categories to our business: our personal wealth management, our 401k retirement plans that we serve as a fiduciary for, and our Chappaqua investment strategies. You can learn a lot more throughout that here. If you happen to be a dentist in this webinar, you can go ahead and click this tab on our website, which is actually just fncadvisor.com/dentist. And I've written a whole ebook for those dentists to really give the foundation of a financial plan, and then go into those that are, out of debt and going into maybe a practice sale or retirement, and then how to actually make those assets last over time. It's a free ebook. All you have to do is enter your email address on that page, and you'll get both a Kindle file and a PDF file. You don't have to be a dentist to request this. 80% of this content is also relevant for other high-income professionals. But for dentists in particular, I think it's an interesting read. So feel free to go onto our website and sign up for that. Otherwise, feel free to check out our blog at FNC Advisor, connect with me on LinkedIn, or shoot me an email if you do have any questions. And always happy to talk and help out. So again, hopefully that some of this was useful and relevant information for you. I look forward to seeing you at our next webinar. Have a good day.